Let's demystify REITs, a game changer in real estate. Imagine owning part of a skyscraper. That's equity REITs. They own properties generating income from rent. Mortgage REITs invest in mortgages and earn from interest. Why REITs? First, dividends. They distribute 90% of their taxable income, making them a reliable income source. Second, diversification. Real estate often moves opposite to other markets, offering a buffer. Third, professional management without landlord headaches. Plus liquidity. You can trade REITs like stocks, but caution is key. REITs are sensitive to interest rates and market conditions. Each type has its own risks, from property sectors to economic cycles. And remember, dividends are generally taxed as ordinary income. In under a minute, you've got an overview of REITs, what they are, why they fit into your portfolio, and what to watch for. It's real estate simplified. So I'm kind of curious, for this group who is very actively buying real estate properties for investments, managing and having rental income, by a show of hands, who owns a REIT? That's what I thought.
I knew that was the answer.
So this could be a very short segment.
Oh, that's hilarious.
Well, I do want to share how before I started investing in real estate, I did invest in REITs. I thought, oh, this is great. I get dividends. If the stock goes up, I make money. And then, like I said, the dividends. So there's two ways. But here's the biggest reason why I don't invest in REITs is when I buy one rental property, anybody, if you buy one rental property, you make money 6 different ways. It's absolutely really amazing. First one's passive income. Obviously, you rent it for more than your expenses are. Next one is equity capture. We buy it for less than it's worth. So we want to make sure we capture equity. Another one is market appreciation. We know over time, the value of the property goes up. Forced appreciation, we put a little bit of money into it. Let's say we put $5,000 into it, make it worth $15,000 more than we bought it for, than the $5,000. So we captured $10,000 there. We also have mortgage buy down. I love this one. Remember, I don't pay my mortgage. I don't pay my interest. My tenants pay for all that. So that is money that's just basically being captured as well. So mortgage gets brought down. And on top of that, tax benefits are amazing. Deferred we have the depreciation is absolutely amazing when you have a cell phone. If you travel anywhere, like anything in your business, you're gonna be making money. So those are 6 ways, just really quick overview. And when I buy a REIT, I maybe make money if the stock goes up. I'll make money in the dividend, which is nice, but I make so much more money when I invest in myself. And the biggest thing, I think Eric said this, I had to get education myself. Like I need to actually do it right. In fact, all my students, like I love fast tracking their success by telling them, I screwed up doing this, this, and this. So don't do that. Do it this way because it's right. And with hundreds of, actually almost thousands of students now, it's great seeing that now they don't have to invest in a REIT. They don't have to give their money to somebody else and say, you invest it for you. I love having control over my money and making sure I'm going to make money every single minute of every single month of every single day because my properties are what's making me money. So those are the big reasons why I don't invest in REITs.
The 6 ways to make money with real estate. That's the mic drop from Dustin. Yes, Eric.
I want to share a horror story, not about a REIT, but about a real estate fund that I invested into. And I think there's a chance my mom and dad are listening to this, and I don't think they know this, so this will be the first time they hear as well. But like 2 or 3 years ago, I invested about $100,000 into this luxury real estate fix and flip investment fund down in the LA area. We're actually still in a lawsuit right now trying to get that money back. But basically, this company and this fund, they'd done maybe like 7 or 8 successful exits. Each of them exited about 20-30% ROI. So things were looking good. They created a 5-year fund. And then I don't know exactly what happened, but the general partner of the fund, his brother passed away. And I think with that, his priorities really shifted in life. And like all the projects fell apart. So we've been in a lawsuit since maybe March or April of this year trying to get that money back. But from what I know, there was over like $15 million in that fund. So a lot of people are not very happy right now. And this is like a perfect example of why I like to take on my own deals now, right? Because I control the buy box, I control what numbers I'm looking for, and like, sure, there's things that are going to happen that are out of my control, but at least something like this isn't going to happen, right? So, mom and dad, if you're listening to this, don't worry, we're about to make that 100K back on this next deal right now.
Thank you for the cautionary tale. I think as the stock guy, as part of this panel, I will just share that I think that even REITs, people need to be careful, because investors oftentimes they just say, oh, real estate investment trust, it generates, it pays a great dividend, it's going to generate income, and they forget that it's a stock and it behaves like a bond substitute. So if you have interest rates, that is going to impact the stock price of the REITs. And the other thing that you really have to be careful about is that there are management teams out there who are not doing what they're supposed to be doing. They're using the REIT as a vehicle to raise cash in the capital markets. They pay themselves handsomely. Not everybody does this, but there are some REITs that I know this is taking place. The management teams are getting rich and they're kind of fleecing hospitals in different investments that they are buying. Not to the benefit of their shareholders, but to themselves. So you have to be really careful as an investor to understand the balance sheet and to understand the margins, and are the dividends going to be sustainable, or is the company just not being run well, and then it's not going to end well for anybody. So with that, let me go to segment 5 and we'll bring it home.